All right, let's kick off this explainer by doing a little time travel. Close your eyes and imagine it's 1998. The world is going absolutely mad for the internet, right? I mean, new companies are popping up out of thin air, and every single investor is fully convinced they've just found the next big thing. People are literally pouring their life savings into tech stocks for no other reason than, well, the company has a catchy .com name attached to it. And honestly, for a couple of years, the hype feels totally justified. Everyone thinks they're a financial genius because the lines on the graphs, they just keep going up and up.
But we all know how that story ends, right? By the year 2000, all that massive overconfidence created one of history's absolute biggest bubbles, resulting in a breathtaking crash. The Nasdaq plummeted by nearly 80%. Yeah, 80%. A drop that was entirely unprecedented in U.S. markets. Traders were absolutely shell-shocked. The sheer amount of wealth that just vanished into thin air overnight was staggering. It served as this really brutal reminder of what actually happens when pure, unadulterated hype fully detaches from underlying financial reality.
I mean, the devastation was so incredibly widespread that even the wealthiest individuals on the planet couldn't escape the blast radius. Take Bill Gates, for example. He lost $1.8 billion in a single week. The source material points out that when the dust finally eventually settled, only 48% of those highly celebrated .com companies actually managed to survive. Millions of dollars just lost in the blink of an eye. And you know what the crazy part is? The internet truly was the next big thing. It changed the world. But the timing, the hype, and especially the valuations, they were completely detached from reality.
Now, fast forward to today, we are seeing that exact same energy and market frenzy, but this time, of course, it's driven by artificial intelligence. And while people are super eager to call it this once-in-a-lifetime opportunity and declare a whole new era, we really have to remember this incredibly famous warning from legendary investor John Templeton. He said, "The four most expensive words in investing are, 'This time is different.'" History doesn't always repeat, but man, it definitely rhymes. So to understand if this time actually is different, the analysis we're looking at breaks down three hidden forces that are currently driving this potential AI bubble.
So let's look at force number one, the magnificent arms race.
Right now, there's just a tiny handful of massive tech companies pretty much deciding the fate of the entire stock market. We are witnessing an absolutely unprecedented concentration of wealth and influence, and they're locked in a literal arms race to dominate AI. These giants, we're talking Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and NVIDIA, they're often called the Magnificent Seven. And get this, they make up a staggering 36% of the entire S&P 500. That is huge. What that means for you is that even if you only own a single share of a broad market index fund, you are already placing a massive bet on this AI arms race, whether you realize it or not. Every dollar these giants invest sends absolute shockwaves through the global economy.
Just look at the sheer amount of cash these guys are projected to pour into AI this year alone, just to dominate the infrastructure and, honestly, just to stay in the game. Amazon is dropping $100 billion to own the foundational network. Microsoft is pouring $80 billion into OpenAI and supercomputers. Google is spending $75 billion to totally rebuild search, and Meta is dropping another $60 billion. Even Apple and Tesla are committing billions of dollars. Make no mistake, this isn't just standard research and development anymore. This is pure survival spending.
To put that into perspective, because those numbers are just massive, that combined spending is a staggering $330 billion. That is literally more than the entire gross domestic product of whole developed nations like Finland or Portugal. All of this capital is being funneled into building the future, all in a single year. In fact, the source notes something pretty wild. This colossal spending spree might actually be the primary thing keeping the broader U.S. economy from sliding into a recession right now.
And why are they spending all this? Well, because the stakes literally couldn't be higher. According to the source, the International Monetary Fund estimates that 60%, yeah, 60, of jobs in the developed world are exposed to AI. That means these roles could be completely transformed or entirely replaced by automation very, very soon. Whoever cracks this tech first, they don't just win a market sector, they gain a crazy amount of global power. It's a race between massive corporations, sure, but it's also a technological cold war between nations striving for global dominance.
Okay, moving on to force number two, the AI money machine. This brings us to the main reason the source material suggests we should be genuinely worried. It's this deeply messy, completely circular funding loop. Here is how it actually works behind closed doors. Tech giants like Microsoft give billions in funding to OpenAI, right? Then, OpenAI uses that exact same money to pay Microsoft to use their data centers.
Microsoft then takes that data center revenue, turns around, and uses it to buy NVIDIA chips. And then NVIDIA turns around and invests capital straight back into OpenAI. These companies are essentially just passing the exact same money around to each other. This allows everyone to record the flow as revenue and artificially push up their own stock prices, all without generating truly organic external profits. It's wild. To simplify it, think of it like the classic California gold rush. NVIDIA is out there selling the shovels, companies like Oracle are providing the land, and OpenAI is the one actually digging the quarry. They are all helping each other lure everyday people and investors into the mines. But the startling truth highlighted in the source is that, financially speaking anyway, nobody has actually struck gold yet. The infrastructure's generating wealth for the builders, sure, but the end products simply aren't covering the massive costs of the operation.
The numbers reveal a massive disconnect here. Take a look at this. OpenAI is currently valued at a breathtaking $500 billion, yet they only make roughly $12 billion in revenue. Think about that. This means they are burning cash and losing money every single month. The entire stock market's current boom is relying extremely heavily on the belief that these AI services will eventually, somehow, find a way to monetize at a scale that actually justifies these sky-high valuations, maybe through aggressive advertising or by completely replacing human workforces.
Which brings us to force number 3, hitting the data wall. So the current market boom practically demands that these rapid leaps in AI capability we've seen over the last 2 years just continue uninterrupted forever. But there is a physical limit approaching. For years, AI has devoured centuries of public data, books, articles, research, historical archives, you name it. The source beautifully compares this to climbing a ladder in a game of snakes and ladders. Everyone assumes the ladders will just keep going up, but by 2027, we might literally run out of data rungs to climb. AI is on pace to consume nearly all human-generated online content.
Because here's the thing, if AI wants to scale past this data wall, it doesn't just need more data, it needs different data. And this highlights a really fundamental difference. Unlike us humans who learn organically from, interacting with the physical world, living life, and experiencing our own unique mistakes, AI currently only learns from the historical data it is spoon-fed. If these companies can't figure out a way to engineer past this data wall, the rapid progress could stall, expectations could completely collapse, and the bubble could violently burst.
All right, so that brings us to part 4, surviving the bubble. With all these classic signs of overvaluation, these circular revenue streams, geopolitical mania, and looming data limits, the source material suggests it's highly likely we are currently in bubble territory. So how do we, everyday investors, actually navigate this without getting wiped out like the victims of the year 2000 crash? Well, first, the analysis suggests don't panic. Instead, it outlines 3 practical steps to protect and even grow your wealth. First, automate your investments into broad, low-cost index funds because over time, historically, the market always bounces back. Second, actively focus on boosting your income right now, maybe through some side hustles so you actually have the liquid cash to buy up market dips if prices do crash. And third, heavily diversify your portfolio. Don't put everything you have into tech stocks. Spread your wealth across different assets like bonds, precious metals, real estate, and dividend-paying stocks.
Because ultimately, even if this bubble bursts, it won't be the end of the world. It will simply be a massive transfer of wealth. If you understand the mechanics of the Magnificent Seven, that whole circular money machine, and the looming data wall, you can absolutely prepare yourself. So the only question left to ask yourself is this. When the hype finally meets reality, will you be panicking, or will you be the one taking advantage of the opportunities when everyone else runs for the exit?